Good morning, hunters, and welcome to the Daily Hunt for Multibaggers on this Thursday, February 5th, 2026.
That's right, and we're digging into the data collected yesterday, February 4th. We saw a pretty intense level of discussion across various social media channels, with quite a few different stocks flagging our AI systems.
Definitely. The sentiment out there, it felt very divided. Some really promising bullish calls, but also a lot of underlying caution and risk flagged by our models. It's going to be an interesting dive.
Let's kick things off with Amazon, AMZN. Our analysis today suggests a stay-away verdict for the short term, which is actually a downgrade from some of its recent buy ratings.
Well, Amazon does look set to materially beat its Q4 25 earnings, driven by strong AWS growth and a robust retail performance. We're seeing insiders buying, which often signals confidence, and there's a lot of buzz around AI initiatives like Alexa Plus. That's a strong growth story right there.
Hold on, Ethan. The market commentary is predominantly bearish for the short term, anticipating a sell-off even with an earnings beat. Users are noting a trend where companies beating estimates have still seen their stock drop. And that PE ratio of 33.67, that's quite high, implying significant future growth is already priced in. Plus, those concerns about CapEx, capital expenditures, could really spook investors in the short term, leading to volatility regardless of the earnings number.
Fair points. So for now, given that market skepticism and high valuation, our AI-generated insights classify Amazon, AMZN, as a stay-away.
Next up, AST SpaceMobile, ASTS. This company is certainly generating a lot of buzz in the space sector. We even saw a user report a successful intraday gain, highlighting its volatility. There's news talking about a bull case theory and the stock making significant jumps, even entering defense work. It's an exciting, high-growth sector, promising massive future potential, Brooke. Exciting, yes, but also highly speculative, Ethan. The company's EPS is currently negative at negative 1.01, and that price-to-book ratio is an astronomical 22.69, which means massive future expectations are already baked into its current valuation, leaving very little room for error. What's more concerning is the substantial insider selling we've observed, over 1.5 million shares in the last 6 months. That's a significant red flag from those closest to the company.
So despite the future potential, based on those financial metrics and insider actions, our analysis for AST SpaceMobile, ASTS, remains a stay-away. No change from its previous stay-away or speculative gamble ratings.
Moving on to Enphase Energy, ENPH. This is an interesting one, as it's our first buy candidate today. It's actually an upgrade for the stock.
Yeah, Enphase Energy is looking strong, Brooke. Users are reporting huge gains, one even turning a significant loss into a hefty profit, saying solar is the future and ENPH is a leader. They believe the worst news for the sector is already priced in, and with interest rates potentially declining, solar could see a significant rebound. We're also seeing strong 2026 guidance and analyst upgrades coming out, indicating a positive shift.
That's certainly an optimistic view, Ethan, and the forward guidance is encouraging. While the PE of 25.45 is off its highs, we can't ignore the high debt-to-equity ratio of 123.98. That's a lot of financial leverage. And despite the bullish sentiment, their Q4 revenue actually declined year over year. For a long-term buy, we'd ideally want to see that revenue growth turn around consistently to fully justify the current valuation and future optimism.
Understood. But with that strong long-term growth potential and positive future catalysts seemingly outweighing current leverage concerns, our AI-generated insight suggests Enphase Energy, ENPH, is a buy. Next up, we have Alamos Gold, AGI. And this is another interesting one because it's an upgrade to a buy from its previous stay-away rating in late 2025.
That's a significant shift, Ethan.
It is, and we should probably ignore the social media noise about artificial general intelligence here. The company itself, Alamos Gold, is reporting excellent revenue growth at 28.1% and truly impressive operating margins over 80%. They're projecting a massive 46% production increase by 2028 at significantly lower costs. Analysts even have a buy rating with a C$65 price target. This looks like a solid fundamental play, Brooke.
Those are indeed impressive operational numbers, Ethan, and the stock price momentum is clear, trading near its 52-week high. However, the debt-to-equity ratio is extremely high at 6.83. While that operating margin is fantastic, this level of debt adds significant financial risk, which we always need to factor in for stability and long-term sustainability.
You've got to balance it out, but with strong operational performance and future growth prospects, our market commentary on Alamos Gold is a buy.
Now, let's talk about Snap Inc., Snap. Our analysis maintains a stay-away rating, consistent with its recent trend, and a downgrade from its buy rating back in November.
Snap is showing some glimmers of hope, you know? The bullish post we saw highlighted potential growth from subscriptions and AR glasses, and to their credit, they did exceed Q4 earnings and revenue estimates, seeing a subscriber surge. There's a narrative for a turnaround trying to emerge there.
Glimmers, perhaps, but a very dark cloud still hangs over Snap, Ethan. Despite that Q4 beat, the net profit margin is still deeply negative at negative 0.086, and their debt-to-equity ratio is a staggering 186.48. Users are calling themselves bag holders and heavily criticizing management's share-based compensation while the company continues to lose money. Even insiders are net sellers, which is a big red flag for me.
With persistent unprofitability, that high debt, and the negative insider sentiment, our analysis for Snap Inc., Snap, classifies it as a stay away. Moving on to Tesla, TSLA. This stock is just a trading beast. Users are celebrating massive short-term gains from options, turning hundreds into thousands in just days. There's strong confidence in continued upward momentum, especially with their new $42,000 Model Y and big investments in AIX and robotics. And get this, insiders are net buyers. This could be a growth investor's dream, Brooke.
That's the volatile trading side, Ethan, but the fundamentals tell a very different story. The price-to-earnings ratio is astronomical at 383.03. That's an extreme overvaluation by any metric. Even more concerning, revenue growth is actually negative at negative 0.031, which is a huge red flag for a company valued on growth prospects. And the debt-to-equity ratio is extremely high at 17.76. The insider buying is a positive signal, I agree, but it's just not enough to offset these significant fundamental financial risks. Given that extreme overvaluation, negative revenue growth, and high debt, our analysis for Tesla, TSLA, remains a stay away, consistent with its recent ratings. Next up, NVIDIA, NVDA. This is an interesting one, as our AI-generated insights lean towards a buy today, which is actually an upgrade from its recent stay away status.
NVIDIA is definitely back on a strong bullish path, Brooke. The approval of H200 chip sales to China is absolutely huge, potentially adding billions in revenue. Analysts are calling it a coiled spring, and Sam Altman himself expressed love for working with them, which counters a lot of the FUD out there. Despite some recent price volatility, this is a golden opportunity to get into the leader of the AI revolution, with phenomenal revenue growth at 62.5% and a net profit margin of 53%.
Hold on, Ethan. Let's not get entirely carried away with the hype alone. While those are exciting developments and the company has fantastic profitability metrics, the PE ratio is still a high 44.66. There's also a significant amount of bearish user sentiment questioning the sustainability of the AI bubble and NVIDIA's valuation. Plus, their debt-to-equity ratio is high at 9.10, and we've actually seen some net insider selling recently. We need to be cautious about buying into such high expectations, despite their strong market position.
Well, the dominant market position and strong catalysts for future growth seem to be winning out. For NVIDIA, NVDA, our verdict is a buy. Let's turn our attention to Rocket Lab, RKLB. This company operates in the incredibly exciting space tech sector. While one user noted it came with higher premiums, it's still a fantastic way to get exposure to this innovative industry. And they've shown strong revenue growth at 48%, indicating real business expansion, Brooke.
The revenue growth is indeed impressive, Ethan, but RKLB is deeply unprofitable with a net profit margin of negative 0.356. Their debt-to-equity ratio is exceptionally high at 40.33, indicating severe financial leverage. What's more concerning is the massive insider selling, nearly 74% of total insider shares sold in the last 6 months alone. That's a huge red flag that, for me, far outweighs any perceived sector excitement or long-term potential.
Those are some tough numbers to ignore. So for Rocket Lab, RKLB, our assessment is a stay away, consistent with its previous ratings.
Now, Robinhood Markets, HOOD. Our analysis suggests a stay away today, which is a downgrade from its buy rating just last week.
Robinhood has shown some really strong profitability metrics, Brooke, with a 52% net profit margin and good returns on equity. We've also seen significant insider buying, which usually signals confidence from within the company. And, there are always new initiatives on the horizon, like potential retail access to the SpaceX IPO that could boost future prospects.
Ethan, recent news speaks of a 40% stock plunge and the stock falling today. Their debt-to-equity ratio is an alarming 188.79, an incredibly high level of financial risk. Despite the insider buying, the high PE of 36.15 suggests significant future growth is expected, but the recent price action indicates the market is questioning if that growth will materialize, especially with such high leverage and volatility. The risks seem to be outweighing the positives here. So for Robinhood, it's a stay away. Okay, let's talk about Next Energy, NXXT. This company is showing incredible operational momentum, Brooke. We're talking 253% year-over-year revenue growth in December, plus strategic moves like terminating their at-the-market program to reduce dilution. Institutional investors like Vanguard and JP Morgan are doubling down, and they're expanding into exciting AI-driven energy management and smart microgrids. This company is executing and really worth tracking. Those growth numbers sound great on the surface, Ethan, but the financial reality is grim. NXXT is deeply unprofitable with a net profit margin of negative 0.86. Their price-to-book ratio is a concerning negative 7.74, which means they have negative shareholder equity. And despite the institutional interest, the stock has plummeted from over $4 to under $1. That signifies massive market skepticism that even strong revenue growth can't overcome right now, given the underlying financial distress.
Wow, those are certainly some red flags. So for Next Energy, NXXT, our AI-generated analysis strongly points to a stay away, consistent with its previous ratings.
All right, let's discuss Reddit, RDDT. Our analysis today leads to a stay away rating, which is a downgrade from its recent buy rating last week.
Well, Reddit is seeing a lot of community engagement, and some users are actually anticipating a biblical pump after earnings, especially with a lower market cap and an oversold RSI. They're striking AI data deals, which could be a strong future revenue stream. Jim Cramer is even optimistic about a bounce. It sounds like there's a real chance for a turnaround.
Ethan, the community sentiment is overwhelmingly bearish for very specific reasons. Users are deeply dissatisfied with platform moderation and the proliferation of bots and AI-generated content, which threatens the entire user experience. The PE ratio is an astronomical 76.35. That's wildly high for a company facing such fundamental challenges to its core product. And a huge red flag for me, insiders have been net sellers, divesting over 42% of their shares. That's a massive vote of no confidence from those who know the company best.
Given that extremely high valuation, those fundamental platform issues, and significant insider selling, our AI-generated insight for Reddit, RDDT, is a stay away. Finally, SanDisk Corporation, SNDK. This one is right in the sweet spot of the AI boom, Brooke. Users are reporting incredible gains, and analysts are nearly doubling price targets to 750, citing strong Q2 results driven by AI data centers. There's a clear bullish intermediate-term outlook, and many see current dips as an easiest dip buying ever opportunity for future EPS growth.
While the long-term AI thesis for memory chips is compelling, the short-term picture is very different, Ethan. The stock has experienced a significant recent drop, confirming user comments about it dipping and drilling. Critically, SNDK is currently unprofitable with a net profit margin of negative 0.117 and an EPS of negative 6.25. Their debt-to-equity ratio is also high at 7.96. While insider buying is positive, for short-term speculative plays, these current financial weaknesses and high volatility make it a stay away until profitability is consistently proven. This is a downgrade from its recent buy rating.
So a stay away for short-term plays, but definitely one to monitor closely for long-term potential in the AI space. SanDisk, SNDK, is a stay away.
All right, Ethan, after a thorough review of today's insights, let's round up our top candidates for deeper analysis. Investigate as buy, Alamos Gold Inc., Enphase Energy Inc., Meta Platforms Inc., NVIDIA Corporation. Investigate as cautious buy, none. Investigate as speculative gamble, Next Energy Inc.
That wraps up another insightful episode of the Daily Hunt for Multibaggers.
A quick reminder, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for joining us on this Daily Hunt, and we'll catch you next time.